Hello and welcome to our latest Insider interview. Today in the studio I have with me Lawrence Burns, Deputy Fund Manager of Scottish Mortgage Investment Trust. Lawrence, thanks for coming in today.
Thank you for having me.
So Lawrence, lots of our customers are well versed in the way in which Scottish Mortgage invests. For those that are less familiar, could you summarise your investment approach and the way in which you invest?
So Scottish Mortgage is a long-term growth-focused portfolio. We're not looking to position ourselves for short-term market movements or macroeconomics. We're looking to find and identify the rare small number of exceptional companies that drive long-term markets and long-term returns. And we're looking for those globally. We're looking from all around the world, and we're looking at them across public opportunities and private. And in many ways, what Scottish Mortgage offers is it offers exposure to the future of the economy. It offers insurance against change and disruption. And that's really what we try and provide our shareholders.
As you've mentioned, you own a mixture of publicly listed companies and private firms. The current split at the moment is 64.2% for public companies and 35.5% for private firms. Scottish Mortgage has a 30% limit for private firms. Is the fact that you're over that limit down to your position in SpaceX, which now accounts for 15.1% of assets?
Yeah, so that's right. We have a 30% limit on our unlisted portion, but I think an important point is that that's at time of purchase. So we're able to go above that and not be forced sellers of our private companies. And our private companies happen to have done phenomenally well recently, particularly driven by SpaceX. That's seen a large increase in its valuation. And it's exactly the type of company that we look for, outliers that can deliver a large multiple return.
Could you talk through how you scrutinise valuations for both the publicly listed companies and the private firms?
I think there's a distinction there between how we value companies as investors and make decisions and the valuations that feed through to the NAV. So if you mean how we as investors value them, quite often what we do is we do scenario analysis, multiple scenarios for a company, looking at some of the worst outcomes and some of the best outcomes. We create analysis of how large we think the market will be in 5 and 10 years' time, what the revenue for that company will be, so its share of the market, its profit structure, so its margins, and what the market will pay in 2030 or 2035 in terms of an earnings multiple. And we try and work out if it's attractive from that. And that's true across public and private. But what feeds into the NAV is different. What feeds into the NAV of public companies is their public share price, and what feeds in for the private companies is a private company valuation that me and Tom, as managers of the fund, are not involved in. That's set by an independent valuation committee, independent of the managers, supported by an external firm that does valuations for us and signed off by the board. And those valuations for private companies are about trying to assign a value that is our fair estimate value of, if we were going to sell the shares today, what would we get for it on behalf of our shareholders? And so we mentioned SpaceX just then. SpaceX is valued at $800 billion, and that's simply based off the last large third-party transaction in December that was done at $800 billion. Myself and Tom Slater as managers, we get an email regularly about these updates. We're not involved in setting the valuation of the private companies.
Coming back to SpaceX, I have a couple of questions from interactive investor customers on our social trading network, II Community. The first one asks, how and when do you decide to rebalance investments like SpaceX or Anthropic when you're still positive on the company's prospects, but they become a bigger part of the portfolio?
So I think a key part of our philosophy is that when you've identified an outlier, to try and as much as possible capture the outlier returns and not truncate them by giving up too early. And I think there are two reasons when a company's been really successful that you end up often selling down. The first is you go to that scenario analysis and you go, actually the upside, it's quite hard to see a pathway to make 5 times our money from here. And so if you go back in the past, both NVIDIA and Tesla used to be large holdings in the trust, 10% or so. And for both of those, there came a point where we did that analysis and went, still a great company, but we can't see a reasonable pathway in the case of NVIDIA when it was at 3.5 trillion to how do you get to 10 or 15 trillion? And so we took major reductions to those holdings and brought them down significantly. The second element is what we don't really want is any one company or one investment view to dominate long-term outcomes of the fund. We don't want one holding to dominate. So there's a slight risk management perspective there, where over time, we'll look to redeploy capital into new and hopefully exciting ideas. So those are the two things that keep in check holding sizes over time.
So in regards to SpaceX, it's a 15.1% position. Are you holding that position at the moment rather than taking profits?
I think at the moment SpaceX is an active discussion. We see that there's huge potential in the future, but that has to be weighed against the fact that it is now a very large holding in the trust.
We have another question on SpaceX, and that question asks whether you're worried about the SpaceX XAI merger. The person who asked the question said, it feels like SpaceX bailed out two bad businesses. What's your view?
Well, I think if you look at XAI, they went out and tried to raise money at the start of this year. And the press reports are initially they tried to raise about $15 billion. The demand was so great they ended up raising $20 billion. So there is a view of people investing a lot of money in this business that this is not a bad business, that this is a leading edge frontier model company that has real advantages within the field of AI. And that merger, the valuation was the same as that one where the investors invested 20 billion. So this was not a company that is doing this merger because it needed capital or to be supported in any way. And then I think the other element is that there is a strong argument about the ability to vertically integrate these companies, particularly around SpaceX and XAI, that the next leg of growth, the first leg of growth for SpaceX has been about putting thousands of satellites in orbit to provide us global broadband through satellites. And that's still being rolled out and has been incredibly successful. A next big lever could be putting data centers into space, where you get reductions in energy cost because you get solar powered and you don't need batteries and so on, and using that to actually deal with some of the compute issues we have here on Earth. And so by integrating that within XAI, you could end up with a very powerful proposition. So if you take a step back, I would say the valuation is validated. It wasn't a business that needed this merger in terms of capital, but it is one that combined provide a very interesting long-term investment case.
Another customer asks for you to describe your idea generation process. And as part of analysing a company or considering the investments you own in the portfolio, how much do you factor in the wider macroeconomic backdrop?
So for idea generation, I think one thing that makes our task easier is that we're quite specific about we're looking for the next generation of era-defining companies. And that rules out quite large swathes of the market of what we're looking for. What helps us quite often in that hunt is networks of company founders and private companies and academics that rarely tell you exactly what company to buy, of course, but they help tell you what are the new trends, what are they seeing in terms of business models, who do they respect. And that, I think, helps a lot in idea generation, that leveraging of that network. And then in terms of the macro, what I would say is you always have to take macroeconomics into account to some degree, but there are some investments in areas where it matters more. So we think a lot about the macroeconomic implications for our holdings in Latin America, where macroeconomics is more volatile. We think quite a lot about the macro and broader political situation when our holdings in China, and we're cognizant of what our overall weighting in China is. So we do take those factors into account. But in the ideal world, what we're looking for is companies that can deliver phenomenal growth almost irrespective of macroeconomic conditions. So I said Latin America earlier. Mercado Libre is an example of that, where over the last 10 years, they'll have grown revenue something like 35-fold, even as the economy may have declined in US dollar terms. And so that's what we're looking for, companies that can rise above the macro, but at the same time, taking it into account as part of that scenario analysis.
And coming back to the 30% limit on unlisted companies, another customer asks whether that limit is restricting you and will potentially lead you to miss out on the next big opportunity, as many companies are opting to stay private for longer.
So I think we're cognizant that because of the success for a number of our private companies, we're above that limit and we can't add to new companies. That's absolutely correct. I think the key thing to bear in mind is how quickly that situation can change. So if you read the current press reports, it will be that SpaceX is looking to IPO in the middle of this year or late this year. And if that happens, suddenly the opportunity, the ability and to invest in private companies is something entirely back on the table. So it's something we're aware of, we're conscious of, but we can see various pathways in which that potentially gets changed very quickly.
Lawrence, thank you very much for your time today.
Thanks for having me.
So that's it for our latest Insider interview. For more videos in the series, do hit the subscribe button, and hopefully I'll see you again next time.